Welcome to this session. We are going to look at taxation of partnerships. Now, with regards to taxation of partnerships, the first key thing that you have to realize is that even though a partnership is a separate legal entity with a partnership deed, we do not tax the partnerships. So what happens? The share of profit is taxed on the individual partners. So it is the individual partner who will suffer the tax, not the partnership as an organization. Okay, so what do we normally expect? You will normally be given that a partnership has done some trade. So all you need to do is get the profit or loss for the year. In most of the cases, it will be a profit. Okay, if it's a loss, of course, everyone gets their share of the loss. It's a business loss, gets carried forward to the next year. But what happens when you have a trading profit? So the concept will be similar to what we had when we looked at the taxation of individuals and when we looked at the taxation of business income. In that, you will have your sales, you have your GP, not GP, but cost of sales to give you GP, you less expenses, and you get your profits. Remember the key concepts around business income: only allowable expenses and incomes are going to be deducted. Yeah? And if they don't give you incomplete records, which requires you to prepare all these, you can start with the net profit per accounts and then adjust for, so you add back the disallowed expenses and then you less the disallowed incomes and then you less the wear and tear allowances, etc. Okay, you can do this and you get your profits. Now the key thing is, how do we deal with these profits? And I want us to have a typical example here. Assuming you are told that we have two partners. The two partners are Poa and Fiti. Okay, so you're told that they are trading as Poa Fiti Enterprises, and you're told that they have made profits of 200 and they're sharing profits in the ratio 1:1. All you'll do is you just determine that each person is getting 100 and 100, and this is what they'll be taxed on as individuals. And the challenge is this, that in many times you will be given some disallowed expenses in the partnership books. Now the disallowed expenses are any transactions with partners. For example, interest on capital. For example, salaries to partners. These ones are not allowed. So assuming in the same scenario where we had Poa Fiti Enterprises, then they tell you their profits is 200, but this one, you're told that this one is after deducting interests on capital, where Poa and Fiti paid themselves each 50/50, as well as salaries of, let's assume, 300 each. So Poa 300, Fiti 300. So what you'll do basically is this: you will start with your reported profits which was 200, and then you're going to add back the disallowed expenses. Now the disallowed expenses in this scenario is the interest on capital of 50/50, which is 100, as well as salaries 300, which gives you 600. So it means that the amount before all these other things was coming to 900. So this 900 is the amount that needs to be adjusted for. So how do we go about this? Very simple. We just say that we have poor, we have 50, and we have totals. So we always say that we have the salaries. Poor got 300, 50 got 300, to give you a total of 600. Then you have interests on capital, which was 50, 50, to give you 100. So now we see that the share of profit will always be the balancing figure. And then the total here should be the total that you have gotten from your adjusted P&L. So in our case here, it is 900. So we just say 900. So we work backwards and find that the balancing figure can only be how much? Can only be 200. And since they are sharing profits and losses equally in the ratio 1:1, then each of them gets 100, 100. It seems as if it's very simple, but there is a very big conceptual difference in just doing this work. So this one gives us 450, 450. To make this matter interesting, let's vary the rates and let's vary the amounts of salaries and such. So assuming we have two companies or two partners, we have partner A and partner B, and they are trading as AB Enterprises. And then you're given a P&L, and that P&L shows profit after deducting transactions with partners, assuming the amount you are getting there is, let's say for the sake of argument, 10,000. And then you are given the transactions with partners. You're told that interest on capital, we have A and we have B. So assuming A has been paid 1,000 and B is 2,000, and assume that there are salaries A and B, salaries of 3,000, salaries of, let's assume 1,000. Then I ask you how you're going to tax the two people, how you're going to share the taxable profits and losses. So the first thing you'll do is you determine the taxable profit. So the taxable profit will be given by the reported profit, which is 10,000, and then you add back the disallowed expenses. So the interest on capital, which was a total of 3,000, and then salaries totaling 4,000. So this gives you how much? This gives you 17,000. Now assuming that A and B are sharing profits and losses in the ratio of, let's say for the sake of argument, 2:1. So in our working, what we'll do is we'll come up with A, B, total. And then we'll say we have salaries, which was 3,000, 1,000, giving you 4,000. We have interest on capital, which was 1,000, 2,000, to give a total of 3,000. So the share of profits becomes the balancing figure. So And for it to become the balancing figure, we are saying that it has to balance with what we got as our adjusted profits here, which is 17,000. So when I work backwards, I get 10,000. The rate of sharing is 2 to 1, or you can make it more interesting, make it 2 to 3. So if it's 2 to 3, then it means that this guy gets 4,000, this guy gets 6,000. Then we can add them up, so this gives me 8,000, and this guy gets 9,000. Okay, so they are to be taxed on this. If there were other incomes, let's assume they had rental income, the surplus, they would again have shared. So assuming the partnership had rental income of, let's assume, 1,000, they are going to share that rental income of 1,000 according to the profit sharing ratios, 2:3. So this gives 400, 600. If they have any other income, that's what they will do. So the taxable income of each person will be the summation downwards. So that basically covers how we do the mechanics of taxing partnerships. Remember that you may be given a scenario whereby whatever you get as your share of profits will be a loss. So that one also happens, okay? And a good example would be if you're given a scenario, partners B and D trading as BD Enterprises, and then you're told that they have made profits after partner transactions of 5K, and then you're told that the partner transactions are salaries of, let's assume, 4,000, 3,000, and interests on capital of 1,000 to 2,000. In which case the taxable profit will be per account what was reported, 5,000, and then you're supposed now to add back the disallowed expenditures, salaries of 7,000, then the interest on capital 3,000, so that now we have a total of 15,000. Now when it comes to the profit sharing, we have B and D. What we'll be doing is to ensure that at the end of the day we don't get losses. Yeah, so this example is not correct. Let's assume they had made losses of 5,000. That makes it more interesting. Yeah, per accounts losses of 5,000. Yes, so add back that, so this gives us 5 and this gives us a net of 5 positive. So when you're looking at the share of profits, you'll say salaries and the interest. So salaries will be 4 and 3, giving you 7. Interest will be 1 and 2, giving you 3. And then we'll have share of profit or loss. Remember, this figure will be this figure, 5,000. So we have to work backwards and get that this is a loss of 5,000. So depending on your profit sharing ratio, if they are sharing in the ratio of 1 to 1, that means this guy gets 2.5, this guy gets 2.5. Okay, so the number when we're dealing about a share of profit and loss can either be positive or can be negative, so it doesn't have to be positive. And that basically summarizes the entire concept.